As I promised you last class that I'm going to go over sensitivity and scenario analysis more deeply. So sensitivity analysis, let's work by itself, one by one, and how it works. Let me just copy this. Now, first of all, as I told you last time, that a sensitivity analysis just shows you how the MPV is sensitive to changes in each variable, but the changes cannot happen at the same time. Like it should happen like separately and independently from each other. Now, constructing the cash flow projection, following the basic rules. For example, if you want to estimate the sales, you want to follow the sales. So what do we do basically? We multiply the unit price with the annual unit sales. How many units you sell and for how much you sell it. This is what we do. Basically this multiply this. So that gives you $200,000 revenue and sales every year. Every year. During the 6 years. So the project will last for 6 years. Variable cost, how much it costs you to produce a certain unit that you sell it. So the number of the units you sell times cost per unit. Depreciation is given, 50,000 for all the 3 cases. Then we derive the earnings before tax, like from sales minus variable cost minus depreciation. That gives you 90,000 of earnings before tax. And the tax rate is 40%. 40% of the earnings before tax. That will help you to derive operational income after the tax. Then we add back the depreciation that we subtracted at the beginning to receive operating cash flow after the tax. And this all we repeat for all years except the last year. The last year is a terminal non-operating cash flow. Expected salvage value is 60,000 in the base value. Okay, 60,000. So that means 60,000 minus the tax amount of that 60,000. So 60,000 so 60,000 minus 0.40% of 60,000 and plus the net working capital. And I don't remember what was our net working capital. The net working capital was 50,000. So if you estimate that, that should give you $86,000 of terminal non-operational cash flow. And that will be added to your operational cash flow after tax in order to estimate the MPV. And the MPV estimated, as you know from the function, from the Excel, here 21. And for the base year, it will be same, it will be fixed. and it is fixed for all years. $121.56.64. It's fixed for all years. Okay, what if we change the unit price? We change the unit price, make it 4.5. So unit price will be not $5 but 4.5, $4.50. And let's see how the NPV changes. Then our NPV becomes 71,819, $75. We return back. And let's see, what if the annual unit sales change? If the annual unit sales change, two variables will be affected. First, sales and variable cost, because these two variables are derived from unit sales. Unit sales was reduced to 35,000, let's say, and variable cost is reduced as well. If we assume the reduction in annual sales, as we can see, our NPV in this case equal to 77,986.86. And we continue. We change the variable cost per unit, so we move back everything before changing. We are changing one by one to see the sensitivity of the NPV to changes in variable. Now we change the variable cost only. What if the variable cost becomes 1.4? And as you can see, the NPV I bring back the variable cost. Now I change the expected salvage value, and the only value will be affected in here is the terminal non-operating cash flow. So it's not 60, let it be 30,000. As you can see, the NPV changed. I'm bringing back the expected salvage value. What if the tax rate changes? The two things will be affected in here. The tax amount, it shifts from 40 to 38. And the terminal non-operating cash flow, because when you sold your equipment, the expected salvage value payment on tax will be changed as well. And that changes your NPV. 129, 165, 13. And I'll put it back, everything. Let me see how the tax rate will change. The required rate of return if it changes. And it only affects the NPV. And it's dramatically increased, 151. And this was the lower case. If you reduce each variable, what will happen to your NPV? What if you increase it? What if you increase it? But let me put it back, the NPV. Okay, what if my sale unit price is not $5 but 5.5? My NPV increases to 170. What if my annual unit sales, but let me return back the price. What if my annual unit sales changes? Two things will be affected in my cash flow projections. Variable cost and sales. So that you can see that my NPV becomes 164. And if I put it back, put it back. Okay. Now I should change the variable cost per unit only. If this is so, my price increases here, and see what happens to your NPV. Oops. Expected salvage value, but before doing that, I should return it back. If my expected salvage value, which is terminal non-operating cash flow, will change, it will increase, let's say, but the tax rate will be the same. And let's see, 127, 236.21. And what else I have here? I'll change the tax rate. So I put back expected salvage value. Put it back. Okay, now I change my tax rate. Two things will be affected: the tax rates amount, tax amount, and terminal non-operating cash flow because of the expected salvage value. As you can see, the NPV 113, 148.15. And the loss, what I wanted to change is required rate of return. I increase it to 14. And the range, like from high minus low, to see how much it changes. So as we can see, let me just compare the results. Where did I get it correctly? Yes, all of them are correct, so that I don't make any mistakes. So as you can see here, the most sensitive NPV is to unit price and unit sales. Then it is most sensitive to required rate of return. And the least is expected salvage value. This is all about the sensitivity analysis. Do you have any questions up to this point?
No.
Feel free to ask, please do not hesitate. Okay, next week, I just want to tell you, I'm planning to give you the quiz. I'm planning to give you the quiz next week. Okay, and the quiz will be on Wednesday. So everything covered up to this point. So up to this lecture, including like sensitivity and scenario analysis. Monte Carlo analysis is not included. Monte Carlo analysis is not included. So the quiz will be here. And the question that you want to practice available on Moodle. and end of the chapter questions as well, up to the subject that we covered.
Sorry, quiz would be on Excel or on Moodle?
On Moodle, you will be given Excel and you have to do it. Or I might ask you a multiple choice, a sample of the multiple choice question. In any way, you have to solve. In any way, you have to solve.
Okay, thank you.
Both cases, if it's multiple choice or Excel, in both cases, you have to use the Excel function to solve the questions.
Can you repeat when it will have?
You will have it on Wednesday next week,
you.
on the 10th of February. It will be announced on Moodle.
Excuse me.
Yes.
Can you explain the range?
Yes, surely. The range is showing you difference between highest and the lowest, by how much it changed, how much the NPV changed if you change only the one variable. The larger the number, the more sensitive NPV to changes in specific units, in specific variable. So as we can see that the unit price has got the largest range, which means that NPV is the most sensitive to changes in unit price. Then as a priority, annual unit sales. Is that clear? Shall I explain
Yes.
more?
Thank you.
Okay. Any other questions related to sensitivity analysis?
No.
Okay, great. Let us move. Okay, this was the sensitivity analysis. Now is the turn to move to scenario analysis. Okay, we've got here the data. Basically, let me just copy this. Come on. Okay, in scenario analysis, we do changes as a set, okay, for all variables. We create different scenarios. The normal case that we live, if there is a boom in the economy, and if there is a recession in the economy. So there are three scenarios will be created. In the first scenario, we create as a normal, like we take this row, base value. Okay, so sales is unit price multiplied by annual unit sales. Variable cost multiplied annual unit sale by variable per cost. Depreciation, we just take it straightforward. Earnings before tax, sales minus cost minus depreciation, and the tax is 40%. Depreciation is added back, and this is what we estimate. And then the last part, what we do is the estimation of the terminal non-operating cash flow. Is the same thing what we did in sensitivity analysis for the base case. And this is our NPV. This is the base scenario. I mean, the scenario that is going something stable condition, like now there is no changes, the economy doesn't go boom, the economy doesn't go down, and so on. Everything is go under the stable condition. And what we will do now, we will try to create a second scenario, which is worst case. Okay, we'll create the worst, where we overestimate the cost and underestimate the profit. So we try to increase the cost at maximum level, and we try to reduce the profit. Okay, the numbers are changing here. So what I do in here, first of all, I need to multiply with a lower price and with a lower quantity. Lower price and lower quantity. Lower price and lower quantity. Okay, this is I get as sales. But when it comes to the variable cost, I have to take the same number of the units and the highest cost. Sorry. The highest cost. Annual unit sales and highest cost. Let me just hide this one because we don't need the base now. Okay. Annual unit
Excuse me.
sales. Yes.
Why we are taking the highest cost?
Because in the worst scenario, we overestimate the cost and underestimate the profit. Does it make sense?
Okay, thank you.
Yes.
Overestimate cost and underestimate profit. This is the rule of cash flow projection for the worst scenario. Then we compute earnings before tax. The tax rate we are taking as it is for the current year. Basically, when there is a recession, the tax rate they're going down. I mean, to help the government, to help the people to survive it. Depreciation we are adding back, and operating cash flow is here. So in here, what I see here is page 1,930. Then I have here MPV, and I don't have the cost here. My investment cost is investment in fixed capital is 300,000.
Can I ask a question?
Sure, sure.
Why in worst case we choose tax 38?
Because during the recession period, it is expected to expect that from the help from the government to ease the tax policy. The government doesn't put any pressure. If there is a debt, as you realize during the pandemic, the government tried to help the entities. They were prolonging the tax payment or maybe reducing, giving some tax subsidy and so on. But basically, you may increase the tax rate in here. You may increase it. But it will depend on the situation and it will depend on the company. So how they do their cash flow projections. So in here we've got.
Sorry, I forget. Can you repeat what is TNOCF?
It's a terminal non-operational cash flow.
Oh, thank you.
There's something wrong. Yes. In here, I just increase the tax rate. Okay, that's why it doesn't match. But anyway, so as I told you, the tax rate is by government, or in the cash flow projection, it will depend on the firm's company. You can increase it. You can increase it to make to consider it as a cost, or to consider it as a cost or subsidy if there is a negative flow for you. So, but one thing I don't get it, why do I have, okay, my terminal and operating cash flow. Let me just add this one to be consistent with my base case. Okay. And my discount rate, oh, that was the reason why I received. So the concern was, why do I receive it positive NPV in the worst scenario? Because it's supposed to be negative. The issue that the tax rate, not the tax rate, the expected return, required rate of return is not mentioned in here. And let's make it that government does not make make easy policy, tax policy. The assumption is this, okay? We see that the government doesn't put any easiness on the tax policy. So it means that whatever the tax is supposed to be, so we need to kind of overestimate. So the issue was raised, could be reasonable to increase the tax rate in here. But again, it depends on the company. Company may not increase it, the tax rate, as exaggeration or overestimation. It depends on the company policy. But in our case, let's increase it because we may consider this as cost. And terminal non-operating cash flow, it just moved. So expected salvage value, this is for how much we sell it and how much change in net working capital. No, let me just estimate from the beginning. So I'm selling it for 30,000 minus 30,000 taxed by this rate and plus net working capital. Okay, 67,400, just a second. C9 times D10 plus B4. Okay. C9 minus C9 times tax rate and plus, okay. Okay, this is expected salvage value. So what I do basically, I add the expected salvage, the terminal non-operating cash flow to the cash operational cash flow after the tax for the estimation of the NPV. And my NPV that's considered good. Okay, and still we get the negative cash flow in here. Okay, this is the best scenario. And guys, let's make a deal here. As I said, for your knowledge, the government tax could be 38, but it depends on the policy of the company with the respect to the cash flow projection. if it says that the tax is not considered as a cost, instead it could be considered in the worst scenarios as a subsidy, we can, and the government do not impose any taxes during the pandemic or during the crisis, during the recession, it can be ignored as well. But in our case, the government does not make any easy tax policy. So the tax will be overestimated, okay? This will be a rule for our case. So in the exam, if you're asked, you will overestimate tax as well. So, but basically when it comes to the firms, they are the one who decides, I mean, the top management, they're the one who decides how their cash flow projection should be estimated. But the main rules are here. Whatever is taught in this class, you're responsible for that. Nothing more than this. Okay. As we can see here, this is NPV. We got negative. Now is the turn to estimate the best scenario. So the sales are estimated. You sell the higher number of the sales and with a higher price. And variable cost is underestimated. You sell it with a lower, the same quantity. Depreciation the same, and we derive the EBIT. And the tax rate, let it be lower. We underestimate the cost because we agreed the tax is as a cost. And estimation of expected salvage value. So we are selling for high minus this times the tax amount, plus the net working capital. Okay, whether did I make any mistakes? Just let me just check it. Okay, so according to this, we can make conclusion that we do not accept the project because in one of the scenarios we get NPV negative, like in recession. So we could be in recession time as well. So we don't control this macroeconomic factor, which is out of the control. So which we should take it into consideration while we are accepting or rejecting the project. Okay. This is scenario analysis. Do you have any questions?
No.
No.
Okay. Great. Now, if you don't have any questions, just a second.